Hey, this is Jussi. I run a small investment firm that specializes in REIT investing, and lately we've been buying more shares of Vici Properties, ticker symbol VICI, as its dividend yield surpassed 6%. In case you're not familiar with this company, Vici is the biggest casino REIT in the world, owning many trophy assets like the Caesars Palace, the MGM Grand, and the Venetian on the Las Vegas Strip. It has been one of the most rewarding REITs ever since it went public in 2017, delivering roughly 4 times higher total returns than the average of the REIT sector. Not only that, but it has also been one of the fastest dividend growers over this time period, managing to grow its dividend at a faster pace than its peers like Realty Income, Agri Realty, Essential Properties Realty Trust, and WP Carey. That's truly remarkable when you consider how tough of a time period this was. We had the pandemic, which was arguably the worst possible crisis for a casino landlord, and then we had the historic surge in interest rates, which has been described as catastrophic for commercial real estate. But even despite that, Vici managed to keep collecting its rent payments. In fact, it kept even hiking its rent payments according to its triple net leases. It also kept acquiring new properties to grow its cash flow and dividends. But lately, its market sentiment has soured a bit. Its share price has dropped by about 23% since mid-2022. And that's despite also growing its cash flow by about 18% during this time period. And if you now combine its 23% drop in its share price with the 18% surge in its FFO per share, this essentially means that its valuation multiple has dropped by 40%, which I would describe as a crash. And so this begs the question whether this is a buying opportunity or should you sell before the company drops even further. Well, as I said earlier, I've been buying more shares, so obviously I think that this is a great buying opportunity. The shares are right now priced at roughly 11.5 times FFO. They're offering a 6% dividend yield, which is a historically high yield level for a REIT of this quality. This low valuation and high yield will seem to imply that the company is facing some severe headwinds, but this really isn't the case. In fact, the company is today bigger and better diversified than ever, and importantly, it has now also proven its resilience to the market, and this warrants a higher valuation multiple as well. Prior to the pandemic, Vici was commonly discounted relative to its peers like Agri Realty and Realty Income because casinos are perceived to be cyclical and the market was worried about what would happen to Vici if we hit a recession. But then we had the pandemic and Vici passed that test with flying colors. I think that was the only net lease REIT that managed to collect 100% of its rents in full and on time. Even the other high quality net lease REITs like Realty Income didn't manage to do that. And this really showed that the casinos of Vici Properties are truly mission critical to its tenants. They kept paying their rent even despite they had to close down their properties because they know that they really have no other alternative. A company like Caesars cannot just move out of the Caesars Palace and build another property a bit outside of the strip or nearby and expect its profitability to remain at the same level because there is real brand value in that property, the Caesars Palace, and there will be many other operators who will gladly take over the operations of Caesars if it decided to move out. And so even despite suffering large losses during the pandemic, these casino operators kept paying their rent in full and on time as agreed in their leases. I actually met the CEO of Vici Properties a year ago at a conference. We filmed an interview with him for this YouTube channel. I'll put a link to it in the description of this video if you want to learn more about this topic and how the properties of Vici differentiate themselves from its close peers like those of Realty Income. But yeah, in short, I think that the fact that they managed to prove to the market that they can very easily withstand a recession, and not just a regular recession, but a pandemic lockdown, which was really the worst possible crisis for them, really, in my opinion, warrants a higher valuation multiple because if they could survive that, what is really going to take down Vici? It sure isn't a regular recession because, yeah, the pandemic was really the worst possible crisis that you could imagine, and even that they survived without any problems. But despite all of that, so despite being bigger than ever, better diversified than ever, and having now proven the concept of mission criticality of its assets, its valuation multiple has still compressed to lower levels. And I think that what has happened here is that Vici's market sentiment has suffered as its growth is expected to slow down this year. Last year, it managed to grow its FFO per share by a remarkable 11.8%, which was one of the fastest growth rates of the entire REIT sector. Its peers like Realty Income grew by closer to 4 or 5%, I believe, so it's more than double. But this year, Vici is guiding to grow by only about 4%, and this is largely because it's going to have to refinance about 1 billion worth of debt at higher interest rates. Moreover, the bad news here is that Vici has more debt maturing in the coming years, with roughly 1 to 2 billion maturing each year through 2030. This is going to inevitably slow down Vici's growth rate in the coming years, and I agree with that, and obviously that warrants a lower valuation. But the great thing here is that Vici is now so cheap and it yields so much that it really doesn't need to grow that fast to deliver strong total returns to its shareholders. Since it's paying a 6% dividend yield, all it needs is to grow by 4% annually, and you should get to double-digit total returns by simply adding the yield with the growth. And then if there is some multiple expansion, that will be bonus on top of that. And I think that Vici should be able to grow by about 4% per year, even despite the headwind of higher interest rates. And that's because most of its leases enjoy CPI-based rent adjustments, which should lead to faster rent growth following the recent years of higher inflation. Then secondly, the REIT also retains a significant portion of its cash flow to reinvest in growth. It's about 30 to 35% at the moment. They also have a strong pipeline of new acquisition opportunities, including some call options on some casinos at a high 8% cap rate, which would result in a nice spread over the cost of capital. It also just recently started expanding in foreign markets. They bought their first properties in Canada, but there are some interesting opportunities for them also in Latin America, in Asia, in Europe, I'm sure. And today there are still very few investors starting casinos in foreign markets, and therefore I think that Vici should be able to pick up some great assets at high cap rates. And then finally, the leverage of the REIT is actually relatively low, and they have well staggered debt maturities. And finally, obviously interest rates are expected to be cut in the near term, so perhaps this won't remain such a big headwind as many people expect it to be. Already within a year from now, interest rates are expected to be about 100 basis points lower than their current levels. And you should also consider that Vici's credit profile has improved in the recent years, so they might have taken some debt, let's say at a 5.5% interest rate in year 2019. I'm making stuff up, but since then they've become bigger, better diversified, their balance sheet has improved, and therefore all else held equal, their interest rate on that debt should actually come down today. And so that's also something to consider, because it provides additional margin of safety. And as interest rates are now cut in the near term, I really don't think that the impact on Vici is going to be that significant as it refinances more of its debt in the coming years. So the base case scenario for me is that Vici is likely to keep growing at a mid-single digit growth rate of, let's say, about 4 to 5%. You combine that with the 6% dividend yield and you get to roughly 10% average annual total returns. And then if interest rates are cut as we predict, then its growth could likely accelerate closer to 5 to 6% per year. Its valuation multiple would likely also expand from today's 11.5 times closer to 13, 14 times. And so you add that upside to the returns of yield plus growth plus the multiple expansion, I think that you could expect closer to 15% average annual total returns. But so in short, here you can expect to earn between 10 to 15% annual total returns, depending on your view of where interest rates are going to go in the coming years. But in any case, even if it's 10%, I think that's a very attractive reward proposition coming from such a high quality REIT that owns very defensive properties. I mean, these are really trophy assets when you think of it. Like the Caesars Palace, the Venetians, these are properties that have been built to last forever. I have little doubt that 10, 20 years from now, they're going to be more valuable than today. They are under long-term, multi-decade triple net leases by which the tenants have to reinvest millions into their properties every year to keep them desirable. They also have to pay all property taxes. Their rents keep going up according to CPI-based rent escalations. And so, in my view, this is really a high-quality REIT, and yet it's today discounted, and the risk reward is very compelling. And this is perhaps why Land and Buildings, which is a famous activist REIT investor, just recently started buying shares of the company according to the latest 13F filing, and I'm following their footsteps and doing the same. But Vici Properties is not the only REIT that we're buying, and if you want to access my full REIT portfolio, you can join High Yield Landlord for a 2-week free trial. It's my REIT newsletter. I share there my full portfolio and all my transactions in real time. I'll put a link to it in the description of this video. And then finally, if you could please click the like button and subscribe to the channel, that will help me a lot to keep on growing. Thanks so much in advance. See you at my next one. Bye bye.